Imagine this. You've finally decided to be responsible with your money. Every month, you put a little into your savings account. $100, $200. Slowly, your balance starts growing. You feel proud, disciplined, financially responsible. But one day, you open your banking app. Your savings account now has $10,000. Sounds great. Until you notice something. After an entire year, your money earned only about $50 in interest. Meanwhile, you keep hearing people talk about investing, stocks, index funds, compound growth. And suddenly you wonder, am I doing this the wrong way? Here's the truth, saving money is important. But saving alone rarely creates real wealth. And this is where many people get stuck. They know they should save, but they don't know how to take the next step investing. In this video, I'll show you exactly how to move from saving to investing without feeling overwhelmed or putting your financial security at risk. Let's start with one simple idea. Saving money alone will almost never make you wealthy. Saving protects your money. Investing grows your money. Those are two completely different jobs. Let's look at an example. Suppose you keep $10,000 in a savings account earning 1% per year. After 1 year, you'll have about $10,100. Now compare that with investing. Historically, a diversified stock market investment has earned much higher long-term average returns than a typical savings account. If your investment earned around 10% over a year, that same $10,000 could grow to around $11,000. The difference may seem small today, but time changes everything. After 20 years, money growing at 1% becomes roughly $12,000. At 10%, it could become around $67,000. Same starting amount, completely different outcome. The biggest wealth gap isn't usually between people who save and people who spend. It's between people who save and people who invest. So why don't more people invest? Because of psychology. Saving feels safe. Investing feels uncertain. Your savings account rarely changes, but investments go up and down. Those price changes scare many people away. If you're thinking, I don't want to lose my savings, that's completely understandable. And that's exactly why you should never invest all your money at once. Instead, follow these 5 simple steps. Step 1. Build an emergency fund. Save enough cash to cover 3 to 6 months of living expenses. This money stays in your savings account. It's there for unexpected situations. Job loss, medical emergencies, car repairs. An emergency fund protects you, so you don't have to sell investments at the wrong time. Step 2. Separate your money into 2 buckets. The first bucket is safety money. The second is growth money. Safety money stays safe. Growth money is allowed to rise and fall because its purpose is long-term growth. This simple mindset makes investing much less stressful. Step 3. Start small. You don't need thousands of dollars. Many investment platforms let you begin with very little. The goal isn't getting rich overnight. The goal is building the habit, because habits create wealth, not lucky timing. Step 4. Keep your investments simple. Many beginners rush into day trading, options, or risky speculation, but simple strategies often win over the long run. Index funds let you own small pieces of hundreds of companies at once. That means better diversification, lower risk, and steady long-term growth. Sometimes the simplest strategy is also the smartest. Step 5. Stay consistent. Imagine investing $300 every month, year after year. With long-term growth, your investment can become much larger than the money you personally contributed. That's the power of compounding. Your money starts making money. Then that money starts making even more money. But remember, investing won't always feel comfortable. Markets will fall. News headlines will sound scary. People will panic. That's normal. Successful investors stay focused on the long term. Think of it like planting a tree. Saving money is like keeping seeds inside a jar. They're safe, but nothing grows. Investing is planting those seeds in the ground. At first, you don't see much happening, but with patience, those tiny seeds become something much bigger. And what happens if the market crashes? Believe it or not, long-term investors often benefit. Because when prices fall, your regular investments buy more shares. And when markets recover, those extra shares become even more valuable. That's why experienced investors think in decades, not days. So let's quickly recap. Build an emergency fund. Separate safety money from growth money. Start small. Invest consistently. Choose simple, long-term investments. And let time do the heavy lifting. Because saving gives you security, but investing gives you freedom. The sooner you combine both, the stronger your financial future becomes.